So Caterpillar is one of these stories that we're basically looking to get into and maintain exposure to growth. And growth is coming in a lot of different ways. And one of the big ways is obviously demand for more materials. You're even seeing sort of BHP Billiton and other material stocks that are just booming. But Caterpillar, obviously, they are sending in all their excavators, and their growth has been extraordinary. And they've actually, through this tumultuous first opener to the year, they've done very well, Kelly. And right now, you don't want anything to be overpriced. The market is killing anything that's overpriced. So this is growth at a reasonable price. And that's really the thesis behind why we like this bet. And we think that this is a large, profitable company that has the potential to ride through this growth cycle that we're experiencing.
Yeah, so the stock is down about 5% today. So it's giving back some of that January outperformance. What they said about China was a little more concerning, right? About slowing demand, and we don't know how long that could persist. I don't know if we should expect that to be a hangover on the stock.
I mean, I think that's going to be a hangover on the entire market. I don't think that that's specific to CAT. So, but without a doubt, that is a concern that should be growing, because there's no question that China, because they were first out of the gate in the pandemic, first out of the gate into the vaccines, first out of the gate into the recovery, they're slowing at this point. They're sort of toward the trough of their growth. And so it makes sense that China pulls back. But you are seeing an uptake and increase in activity, for example, in Latin America. And the U.S. continues to go, even though we are slowing, we're still at well above long-term averages for growth. So the demand is still there. And I think that is still, an enormous part of Caterpillar's profitability.
All right. So CAT is your buy number one. Number two is ExxonMobil. And that's off to another hot start. It's already up more than 20% this year. After gaining 48% last year, they're getting a boost from energy prices, rebound in travel. They're expected to double revenue when they report next week. But are you more nervous after Chevron today?
I think the thesis here really is things that help maintain an inflation hedge on the portfolio. And this is obviously one that participates directly in inflation, because as oil prices go up, they benefit. But also, this is a company, that has been really, really finally outperforming in their earnings. And could there be dips and a roller coaster ride? Yes. However, the broad cycle is in their favor. And so even though they may have ups and downs, I think that there's still, a good 12, 18 months of runway for this company to continue to perform and help hedge a portfolio in the face of lingering inflation.
And I know you tend to be a stock picker, but what about the energy ETF more broadly, or the whole sector at a time when people are looking for that kind of pricing power hedge?
Oh, no, we love the sector right now. This sector is a space that you can participate in broadly. So this is a rising tides will lift all boats.
All right. And Exxon, you think, is going to be one of those. That's buy number two. Final buy of the day is Bank of America, coming off a strong year, which saw shares up 46%. Unlike competitors, they had strong fourth quarter results, 28% earnings growth, and they could get another boost once the Fed begins raising rates. But that curve is flattening, Gina.
Yeah, I agree. I don't love the flattening curve for the banks generally. However, increased activity and going into interest rate raises, hikes because of increased economic activity are good for banks. And if you look at Bank of America specifically, so not all the banks are participating in this. Bank of America is really growing their lending book, and so in the face of everything that's happening, they're continuing to grow their earnings and growing their profitability. And that's beneficial for Bank of America. We've actually participated in Bank of America. We've had Bank of America through this cycle, and they've done well for us.
All right. So those are the three: Caterpillar, Exxon, Bank of America. Now let's turn to the one to bail on. And it's been such a tough run. Peloton, you're saying, and they officially plunged below the IPO price last week. They are down 30% this month. And I would like to hear you talk about it, because some are looking at Robinhood and Peloton and some of these others and going, okay, can it really get any worse at this point? Are these buying opportunities? Why do you stay away from Peloton here?
The issue that I've always had with Peloton, and I wasn't a bull that turned bear. I actually didn't like the story from the very beginning when everybody was buying them into the pandemic. And that's because the data suggests that most average human beings will sort of quit going to their gym after 6 months. They'll stop using a wearable device after 3 months. And Peloton is not immune to that, right? They were always going to be set up for that kind of churn, but the price was pricing them like this sort of long-term subscription model. But at the end of the day, the subscription depended on people being willing to get on their bikes and actually cycle. And human nature just works against you. Returning to work worked against Peloton because now people had less and less time to sort of do that. And Peloton is still, at the end of the day, they're a device maker. They're a manufacturer of product. They're not really yet a software play. They're not a SaaS play. And they need to really work hard to get that game on. I mean, there's a lot they can do with that device that could actually help them earn the premium that they've had in the market, but they're not doing that. All they've done is create new products that just are subject to the same problems.
They are creating a lot of new products. So what would you like to see them do with the core product to improve it? And what about those who think they could end up being a takeout target?
Well, so I think that right now they have the device that would allow people to be able to gather together and socially cycle, right? That social aspect, they are set up for that. They have a camera, everything is there, and yet they're not doing it because the only subscription model is for you to subscribe to their classes rather than get together with all of your cycling moms and have a little, cycle day, for example. The second thing they need to do is they need to bundle entertainment into their subscription. If you had Netflix, if you had Amazon Prime bundled into that, you're going to capture sort of the average, let's call them, person who wants to think they're working out, but they aren't really that serious about it. So if you just cycle through like a good, watching Bridgerton, then that is a whole segment of the market that they're missing by being sycophantic about how you subscribe to their product.